All right, welcome in everybody. I'll give you a couple minutes for the stream to catch up on YouTube. It feels like forever since we've done one of these AI circles, and I think we only maybe missed a week. But thank you everyone for joining. As always, I already see a big group of folks coming in. Just say hi in the chat if you could. Make sure you can hear me all right, and then here in a second I'll get Kelly on here. And we'll get on with things. Just while we're letting everyone join, you're probably familiar, obviously, with the disclaimer. We say it every time. We're going to do something a little different on the agenda today. We're actually going to start with the Q&A questions. I got a couple really good pre-submitted questions that I wanted to go over today, and then we'll go into Kelly's market update. I don't believe we've really made any trades, so this segment might be a lot of nothing today. But just giving you guys a heads up, feel free to get those questions in early. I know generally we're going between a half hour and 45 minutes. We're going to try to keep it closer to a half hour today. So make sure you get your question answered and get it in early. So with all that being said, Kelly, let's have you jump in here. How you doing today, Kelly?
Was certainly a lot better than I was last week, Lee. Hello, everybody.
Yeah, you couldn't talk or something, right? That makes it hard to do a live stream.
Yeah, I have noticed that having having a mouth and having to be able to use it is kind of important if you're doing a stream or being an actor or being an anchor on TV. Yeah, you kind of need your voice.
Seriously, I guess you give some grace to like the musicians that cancel their shows and they can't talk and stuff like that. It's like, yeah, I get it now.
Empathy, yes, I have it.
Empathy is a better way to say it. Well, awesome. Well, before we get into a couple of questions, I'm just going to knock out this disclaimer. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk, and you should speak with your CPA or financial representative to ensure the iFlip Smartfolios you select are suitable for your investment profile before trading in a live brokerage account. Whew, got it all done. All right, Kelly. I'm going to go over one or two of the questions, and I'll kind of paraphrase here. The first one I got was this person put their 2024 contribution onto our platform. The gist of it is she's like, should I just put $700 into all 10 of the Smartfolios? I know we just did the disclaimer. We can't give advice and all that, but feel free to take this and run.
First of all, it's a good question. That way you can look at it two ways. You're diversifying, even though there's a lot of similarities regarding the different portfolios by doing that. So that's one way of looking at it. Another way you can say, hey, if we want to see how Flip is doing in each one, let's put $700 into each one. But the reality is that would be true. I think if you had $70,000 and you put in $10,000 or $7,000 into each portfolio. But when you have $7,000, you're much wiser to not be diversified that way and to pick a portfolio that fits your whatever needs you might choose to have in terms of your risk and reward. And the reason you would want to do that is because when you put just $700 into something, it's not easy to, even with fractional shares on some of the symbols we have, what ends up happening is you'll have a portfolio where you're going to have a lot of fractional shares. And if there's some symbols in there that the broker dealer, the clearing broker doesn't offer us, then you may not get that symbol at all. And what happens if that symbol is NVIDIA? You may not get exposure. Why? Because NVIDIA wasn't even available to us, at least until maybe recently, to be able to trade fractionally, especially because of the split that just occurred. You may not be able to get exposure to something that's gone up literally hundreds of % this year.
Yeah.
So the good thinking about this is with the small amount of money, $7,000, I think you're much wiser dividing it by two and picking two portfolios, or just pick one that kind of fits your needs. So in that case, I would probably go balanced. Again, we're only opining, but it really doesn't make sense to take 10 portfolios for $700 each. Given the nature of the way machine learning works, the way fractional shares work, et cetera. So I personally would advise against that.
Sure. And something else that you kind of just brought up, I was not to blindside you here, but you brought up NVIDIA. And this may be very elementary to some people, but officially on Monday, the stock split. Can you just explain what that is and maybe the purpose of that?
Yeah, absolutely. It's very simple. NVIDIA was trading at $1,200 a share. If you remember a few years back, Amazon was
Yeah.
trading at $3,500 a share. And that actually goes to the previous question. When you have a share that is so expensive, it has become very difficult for a lot of people to buy it individually. Only institutions can buy it when it's that expensive. So you've essentially, when your stock is so expensive, you've limited the access to a lot of investors to buy your stock directly.
Right.
It means by doing a split, what the company is trying to do is get a broader audience to be able to look at their stock and say, hey, I can buy that. So at $120, now $125 a share, it's much more affordable to buy a couple of shares, 3-4 shares, you got $500 worth, and as opposed to buying no shares when it's at $1,200.
Sure. Yeah. Would you rather 2 shares of the SPY or 1 of NVIDIA pre-split? And just on the math of it, so it was a 10-for-1 split. So use easy numbers. Say it was $1,000 a share. You had 1 share at 1,000. Now you have 10 shares at 100.
Exactly.
Yep. Cool.
And by the way, it's very noteworthy to mention that at the new price, it split at around 118 area, 117. It's already 125. Generally, the year after any stock splits, it goes up about 25% in the 12 months after the split. So that's why you see a little run up in the stock from where it's the split price from just literally Monday. So it is a stock that, as much as I think it's expensive, knowing that this particular stock was something that is now worth more than Apple.
Yeah, that is just crazy.
And it was a stock that that when you look at your computer screens, generally the board that your computer screen uses to render the picture is an NVIDIA board.
Yep.
And then all of a sudden now it's the AI darling. And it is now, it doesn't have the sales or the history to warrant a $3 trillion evaluation. So I'm always wary of that. And we could talk about that a little later if you wish.
Sure. And not to go maybe too far more down this rabbit hole, but you kind of brought it up about this stock splitting. Typically in the year, it might roughly go up another 25%. Is that pretty common? Is it or is it common, let's just say, for a stock to split and then people dump off a bunch of shares and then the price retracts?
That's what you would think, but that is not what happens.
Yeah.
I mean, this is just a historical thing. You see it on the news. You could Google it. It's like, that's why a lot of people, right before the split, they like to buy the stock once they announce the split, thinking, hey, I should get 25% in the calendar 12 months after that. So if we look at what the split price was, we could literally calculate what we think it could go to this year for the 25%. My instinct is that this particular stock will follow that guideline. And as a result, we did buy some in some portfolios.
Perfect. I don't want this to be the NVIDIA AI circle. So I still do have other questions, but we'll maybe save them for another day. The other pre-submitted question, and you guys have probably seen that we added iBit to our BitFlip Smartfolio. That is the Bitcoin ETF, for lack of a better way to say it, that is on the public exchanges. You can buy it just like NVIDIA or Apple or anything like that. No need for wallets and all that other stuff through a Coinbase or anywhere else. But there was newish news still about Ethereum coming out with them, coming out with an ETF. Do you have any thoughts on that?
Yes and no. Let me start with the no. I'm not cryptocurrency is a new item. We all know that the Cadillac is Bitcoin. We all also know that if there's any competitor to that, it's Ethereum. And we also know that if there's any competitor to those two, it doesn't matter. Because this is a new A, it's a new technology. B, it actually creates a new currency. We don't need 3 worldwide currencies or 4 or 5 or 6. And my instinct is we only need one, which is why I am not interested in an Ethereum ETF, even should it come out. Yes, it will open up the doors to people that don't want to have uh, wallets and participate in a very expensive methodology of owning Bitcoin through the Coinbases and things like that. Um, so my instinct is I'm a Bitcoin person. I'm focused on IBIT. In Ethereum, yes, there will be an ETF. If someone wants to buy that and they think that Ethereum is an alternative bet to Bitcoin, they're welcome to it. But I have no advisement either way. I'm just not personally interested in it. And it'll be available on the platform for people to buy individually, but I'm probably not going to work with it, especially in the near future.
Sure. And I could be wrong, but I haven't seen them come out with a symbol yet for it, which leads me to believe there's no release date yet. So who knows how long away we are from that becoming a thing. But as soon as it gets to the market, like Kelly said, we'll have it, and feel free to buy it if you'd like.
Yeah.
My last pre-submitted question was about older smartfolios, and honestly, I forgot because I'm maybe so into my day-to-day. I totally forgot about the all-market ETF smartfolio as well as SPY that we came out with right around the same time we had Red Oil as well. So this person kind of asked, would my money be better utilized in a new smartfolio? And he uses these two right now.
Yeah. Yeah, I look, but early in 2023, we came out with the balanced, the aggressive, and the conservative portfolios. Those portfolios were designed to essentially replace the SPY and some of the other portfolios that were out there. The reason, because we're a broker dealer and not an advisory, we can't tell people what to do. So they're working with legacy products. Not that the legacy products are bad, but they have been underinvested because of machine learning reasons over the last year. My instinct would be in the current environment to move. If it was me, I would move my portfolios to one of those 3 core portfolios, depending on your risk appetite. I do think the SPY is still a very good portfolio, and it will have its day. However, again, it is legacy, and we will ultimately unwind that at some point, and move those things into alternative portfolios as people decide to do that.
Sure. And honestly, a lot of people on the call might never have even heard of these portfolios before, right. But this was a person who had been with us forever. And my only other thoughts on that would be, like, say balanced, for instance, and not that it happens all the time, but there will be an occasion where, a stock changes in that, let's say Boeing and we switch that out with Verizon or something like that. You don't have that benefit, I guess, in, as you put it, an older smartfolio where we're not really monitoring it as much. We're not going to liquidate your positions, but it just doesn't get the time of day, I guess, that maybe some other ones do.
Correct. And the thing is we can't, because again, as a software company and a broker dealer, we behave like a broker dealer. We are not allowed to do it. We cannot give advice. And that's why the disclaimer is out there.
Sure.
Because shows like these are often looked at as news, because I watch many of them myself to get other people's ideas. And again, they can pontificate all they want. They could speak however they want, but it is recognized as news. But they're not regulated, and therefore they don't need to have a disclaimer. We do.
Sure.
So again, we can't maneuver people's portfolios. That's why we do the AI circle, by the way. So you get an idea of how AI is, how we use it, how we build upon it, how we offer products on our platform that utilize it. And that way it allows you to we try to inform you as to what, we've done and what's available, but not to make a physical, a verbal recommendation to choose it. It is obviously, I think you all know that that's not within our purview.
Perfect. So those are all the pre-submitted ones. Before we get into your market updates, we do have a couple in the chat here. There we go. It's just taking a second to load. This from Jim, another longtime customer. It said, when building a custom portfolio, can we pick the algorithm or is it pre-assigned to the stock?
It is pre-assigned. However, I'm going to note something. If you remember when we first developed our platform, if you're a longtime customer, Jim, we did allow that. And then when we moved over to the mobile app, we said, no, we're just going to pre-assign. So if it's Apple, it's going to use, say, bench risk system, which is one of our methodologies. And that means when you choose bench, if you choose Apple in a smartfolio and you pick it, it's going to use that system. However, probably within sometime in the third quarter, fourth quarter at the latest, we will offer more and more products to say, hey, if you want to build a custom portfolio, you might have, say, 3 different or 4 different or even 5 different underlying processes you could use. But remember this, on top of all of those processes, there is something called the machine learning component. The machine learning isn't different for different types of base products that we have. This is a whole subject that maybe we should probably do a video on, of how machine learning is overlaid onto other kinds of methodologies that are more algorithmic, which is part of our secret sauce.
Sure.
Where we use basic underlying algorithms to set us into positions, and we use machine learning to be able to help us exit those positions. So the general rule of thumb as an investor is you should invest. Otherwise, why would you be called an investor? Why would you put money into a stock account or a brokerage account? But the second thing is that we use machine learning to help guide out positions that are failing. And I could give an example of that on the screen if they're, when Lee is done.
Yeah. And Jim, the second part of your question was about GameStop. And I'm not saying that this is something you necessarily wanted for sure, but that's not something we have the AI mapped on. So just for what it's worth, you might just be using it as an example based on obviously the volatility it's had and all of that. Ogon said we should keep NVIDIA now with the question mark. And then also about NVIDIA, basically the real worth of it. Is it really worthier than Apple? I like that word, worthier.
Well, is that Otgon? Hi, Otgon. That's a good. Is it worthy of its valuation? In my opinion, of course not. I think it is essentially it is kind of a meme stock in its own way, in a totally different way. A meme stock like AMC or GameStop, we all understood what that was. Those were things that occurred after COVID when everybody had nothing to do and all they could do is sit around in their underwear and trade. And so that's why they would trade companies that were very cheap, $5, $3. We call those pink sheet markets. In other words, they're so cheap that, and they at one time were more expensive, they became so cheap that people just traded them, very similar to the original trading of like a Bitcoin. It's something that fundamentally should go out of business, but for some reason it goes from $3 to $80. Why? Because in today's world, markets can be manipulated by a bunch of pundits that do, seriously, sadly, webinars like the ones you're watching right now. They can get on and they can drive a stock if they have enough followers. If there's enough money and enough followers, small retail buyers, they're actually were proven to be able to overcome large hedge fund bets that are much smarter. And so that created this kind of new way for funds to beware that the common man in these chat groups could be so powerful. So in terms of NVIDIA, it is really hard to do, as much as I don't believe the stock is worth $3 trillion because it occurred in literally 7 months, that it becomes the third or second most valuable company in the country, actually the world, behind Microsoft, which means it could easily overtake Microsoft. Is it really something that deserves that from these companies that have established themselves for 30 years? I find that difficult. And honestly, if it wasn't so much demand for it, I'd be a short of that product. And so that's me, but there is no way on this planet that I would short that stock given the statistics that are behind it. And the main statistic right now, it's hard to deny, is the 25% jump, on the announcement of a stock split. And I think the announcement came when it was around $1,100 a share. So $11.50. So if it was $11.50 a share, that means when it's split, it would split to $110.50. Well, we're now trading at $125. It only has another $8 to go to be up 25% already. And that's only after 1, 2, 3 days of trading.
Yeah.
So this is a stock that could be up, given the demand and the craze behind it, it could maybe double again. And at some point, folks, this will be in the days in the future. It will be something that will be reckoned with, I think, in a most terrible way. Where a stock like this, it does remind me of the 2000 tech bubble. And who knows? We may find that companies like this will have a competitor, which would knock the price of stock like this down at least 50% at some point.
Yeah.
That being said, for now, I wouldn't exit the stock. It just has so much momentum, so much follow through interest in it from retail. It's going to be hard to back this stock off for any time I can see in the future.
Perfect. Last question, and then we'll let you as in your never mind.
Right.
We'll get you into your market update. Jim, the short answer to this is no. Just because that's a crypto. These other two are coming out with ETFs that will be on the exchanges. And then Kelly, his other question was about your thoughts on Southwest. Why don't you just cover that when you start sharing screen and go through the stocks and everything else like you normally do. So
Okay.
I will hand it over to you and get your screen up here and let you run.
All right. Let me make sure this is a little better. And just please pardon me, Jim, on Southwest. I'm not Jim Cramer. I am Kelly Korshak, and Kelly Korshak doesn't know stocks the same way a Jim Cramer does, for better or worse. Jim Cramer knows all the stocks, all the earnings, all the CEOs. I just look at stocks in terms of data, and so that's all that matters. So I'm not familiar with Southwest, but I'll try to get to it in this webinar over the next 10 minutes or so. Let's see. Well, okay, everybody. Again, today, sorry, one more. I'll start like this. Sorry for missing last Wednesday. I literally could not speak. It would have been a very interesting AI circle last week had I done it. But forgive me, and here we are the following Wednesday. Today, the market came out, and we saw a tamer, I have to quote, a tamer inflationary numbers that came out for our CPI. Tomorrow we'll see PPI. They did tame. And as a result, the market today opened higher. The Dow at one time opened up 360 points higher. However, it ended up down on the day by 35 points. However, the NASDAQ opened up, and it didn't settle on its highs, but it did settle right around its opening, up 250 points, which is another 1.3%. And the S&P was up 0.85%, and creating a little gap here that I suspect will be filled at some point over the next week or so. That meaning that the markets, I feel, are a little bit overdone. But let's take a look at the bond market. Obviously, what that means is if there's tamer inflation, along come the very, very positive people that think we're going to get interest rates cuts. Well, last year, as you know, we came into 2024 thinking there was going to be 7 interest rate cuts. Well, it's almost halfway through the year, and we've had none. Now, because of this most recent number, nothing close to the 2% Fed target, they now suspect 2. By the way, a month ago, they suspected none. The month before that, they expected 5. So we keep running into a situation where the market is eternally optimistic. The stock market is generally this way, and that's why it generally goes up, especially the indices. However, the reality of it is that interest rates likely will not be cut this year. It is an election year. Generally, the Fed tries to stay out of it. We've been through this before. That being said, here is the bond market. This is the 10-year note, a candle chart. I'll put it for year to date. So here we are year to date. You can see the market is it is lower on the year. We started the futures at 113. We're now at 110. So we're just off a few percent on the year on the 10-year note. And the note, by the way, has, taking a look at this huge downtrend since COVID. We've seen this. I've pointed this out many times. Here comes the COVID highs here. This is the low of interest rates. That's when we could all get that 3% or even less mortgage. Those days are gone. Now we can get a 7% mortgage. And here we are. So the interest rate market has gone up in yield, down in price. But I have noticed, and I've been very bearish this market, it hasn't followed through, and the stock market hasn't noticed this yet. But we do have a higher low from the low achieved 3 times. So our lows were in October of last year. Then we made another low here in April of this year, just 2 months ago or less, which was higher than this low. We made another drop low, which was higher than that low. And now we've made another little low, as you can see right here, that is low, that is higher than this low. Generally, when you see higher lows, you're beginning to see the beginning of a rally or a continued rally. So this is a 200-day moving average, this little orange line, if you can see it. This is a very important market to watch. If this market starts to move higher, we will get those interest rate cuts. If not this year, maybe in 2025. I don't suspect that to happen, but we must pay close attention to this. That being said, this is what's going on here. And I did show you that the Dow, even though it opened up higher, it closed lower. The Dow is literally only up approximately 4.5% to 5% on the year. So the other markets are going along at huge clips, but the Dow is not. This is called a divergence, and that's something we also have to pay attention to. Also, overall breadth of the market is also weakening. So we are seeing newer highs. There's no doubt about it. There is definitely enthusiasm. There's definitely demand, but it is something to be wary about. It is either the wall of worry or there is something afoot that can knock this off. I don't know which one it is yet. That's why I've been under a conservative stance and focused on dividends. I think that's the best way to go for me at my age, but for you, it may be different, but it is noteworthy. The market right now, as you can tell, is being led by the NASDAQ. The S&P is NASDAQ heavy, with about 40% of the stocks in the NASDAQ being represented by the Mag 7. In other words, the 40% of the move of the NASDAQ is really tied behind technology. And the Mag 7 represents somewhere in the area of 75% of all technology. So these are things that concern me. A very narrow market led by technology, very similar to the 2000 tech bubble. And that's one of the things that scares old timers like myself. So that's something I'm very wary of. Here's NVIDIA, by the way. We should have to look at it. I've noticed this little crazy spike peak over here the other day. Don't be surprised to hear about this in the news at some point. That looks like a fat thumb. So I've seen this before, and that was that flash crash deal that we saw back in, I think it was 2015. Let's go to, look, the banking stocks are kind of doing good. Here's JP Morgan just off their highs. Charles Schwab has had a good comeback from a huge debacle that they had a while back. It's here, but they've kind of recovered from it. So that's okay. Charles Schwab ultimately is a bank. Goldman Sachs, same thing, put on a huge rally, literally increasing 50% inside of the last 9 months, kind of something I can't buy in this case. Again, however, it is part of some portfolios, and that's good. I'm noticing also the cruise lines. I mean, they're kind of hanging in there. The American consumer seems to be alive. Again, here's the case of higher lows. You see that? This is always a good sign. So these are stocks that I'm very interested in. These are things that if I was a stock picker and I was just buying, these are things that are cheap. They're kind of interesting. You might want to get involved with. So those are things that just keep it in the back of your mind. This is Carnival Cruise Lines. Here's Norwegian Cruise Lines. Same kind of thing, higher lows. Well, not here, but still higher lows and generally higher prices, generally kind of moving higher. I like these dividend stocks, AT&T and Verizon. They're also doing the same thing. They're slowly moving higher, but they offer, again, around a 6.7% dividend. They are telecommunications, and I think they've been lost in the shuffle amidst the technology run. So these are also things that I'm paying attention to. Finally, I'm actually kind of looking at these Fannie Mae stocks and things like this. These are things that are interesting to me. This is Fannie Mae. It's $1.50. I don't know if I really love this, but I have to look at it in the context of that these are called government-owned equities, the SOEs, state-owned equities, sorry, SOEs. But they are as companies that help facilitate the lending of money for mortgages. As you know, mortgages have been harder to get. They're at 7%. But I've also noticed that, again, these are private-owned companies. They just have a contract with the government to do the paperwork behind giving out a loan. Same thing the government has with a bank. They're marching higher. Very noteworthy, under a higher interest rate environment, either there's a greater spread or there's something going on in these stocks. Don't know what, but that's something to note. Let's go to Bitcoin in the form of the IBIT. There's not a lot of data for this stock, but we know it goes back a long way. And the IBIT stock is kind of close to its highs. In other words, Bitcoin is trading around 68,000. The high was around here, 73,000, about $41 a share area, 41.50 a share for IBIT. We're kind of close to those highs. Anybody in the BitFlip portfolio could look for a buy coming up where we would be a 100% long inside this portfolio. So that's something that is also afoot. I think another thing to note that I think is kind of important. Oh gosh, we're running close on time as usual. It's amazing how fast that happens. Is the idea of what is going on in again, some of these technologies which are leading the way. And my instinct is, as I fall back to this to close, is that these technology stocks just can't seem to attract enough capital. More capital wants to go in every day. So today, because interest rates went down because of the softer number in the inflationary side, technology companies like lower interest rates. I've always had struggles as to, I understand arguments on this, but technology companies are cash rich. So they're not a function of needing money like a utility when they want to go do something. They just buy it. But interestingly, they don't really have a lot of moves to do except buy their own stock because they're not purchasing companies with all the cash they have. And they have a ton of cash because their equity prices have gone nothing but higher. So again, there's a lot of things out here that create the wall of worry. I definitely am climbing it. I don't know really how to respond to a market like this when the tide is bringing up most everything, except we see decay in a lot of these indices. And from the market breadth to the Dow Jones, even, the Russell is just hanging around steady. I'm not seeing I'm not seeing the things I would expect to see under such huge amounts of cash coming in. So let's real quick go to one thing, by the way, and I will close. McDonald's. I mean, we all know McDonald's. Everybody, of course, has been there. I haven't been there for years. It's not my favorite food. But again, this is a year-to-date McDonald's. McDonald's is down on the year. This is also a Dow Jones Industrial stock. Why is McDonald's under this pressure? Is it the higher labor costs that they find now across the country under this current administration? Is that something that's going to eat at their bottom line? Well, no, they're franchised. So that's the bottom line of the franchisees, much more than the sales. So it could be that maybe they're pricing themselves out. I've heard these McDonald's meals now are like $12 for a burger and fries and a Coke. That seems a far cry from what I remember from the last time I went to McDonald's, which had to be about 7 years ago. I don't remember paying $12 for it, nor would I. I don't understand the decay of some of these stocks. These are examples of things that I don't quite understand. Let me finalize with Southwest Airlines and see if I can find. There we go. Southwest Airlines Company on the New York Stock Exchange. Now, first of all, let's see what its dividend is. 18 cents, so nothing. No reason to own it for a dividend. It's a stock that certainly doesn't look like it's doing anything. I actually know a person that is a pilot there. It's sitting on its 200-day moving average. This is one I would just pass. In other words, if I was a technical analyst, I wouldn't do anything with this. It doesn't look like it's going one way or the other. So it's honestly, it falls to the disinterested column for me. So on that, wow, I just ran my mouth for 17 minutes. I'm sorry, everybody, but that's about what I got today.
No problem. Thank you, Kelly. Unfortunately, your video cut out and you're just stuck there.
Oh,
we can hear you. We can hear you just fine, though.
It's happening more and more. Let me turn it off and turn
right.
it back on, and let's see if it comes back on. And there I am, probably in a less compromising position than I always get caught on when I do these things.
Right. It's not.
I
anyway.
guess. Let me see if I can lower the I'll go to, how about this?
Sure, you'll get it all figured out right as we sign off.
Right. As soon as I sign off.
There you go.
Yeah, there it is.
Jim, I'll answer your question. He asked, do we have a portfolio of 3 to 6 high dividend stocks? So Red Oil only has 4 stocks in it. All of them pay a dividend. Conservative would be in that same category as well. And I think Balanced has about 5 or 6 as well.
It does. It does. The conservative portfolio is what I think would weather any kind of market downturn. So again, because the dividend side, the conservative and nor the Red Oil are very high. Oil, by the way, I guess we could maybe make a quick statement on that. I'm noticing that oil, we did notice it got down to the low 70s. It's now kind of marching back to higher prices. So when I see things like that, the oil market has been generally very good to me and our customers for the last number of years. However, we are coming off. The tamer inflation data is generally bad for oil. And here we noticed it today. Here we see Exxon down. Exxon is at 124 was the high. It's at 111. So it's lost about $11 out of 124. So it's down about 10% off its highs. But and I can also say the same thing is true of Energy Transfer and all Plains American stocks that are oil pipelines I like. But again, these are stocks that are paying closer to 7.5% dividends. And that's a dividend I really kind of like, especially under the environment going forward. A change of administration would vastly help these companies, where I still think they will achieve their $24 price targets each. And ExxonMobil, I am not unwilling to give up on a stock that has been so good to me, and it still pays a good dividend. It's paying about almost $4 on 110, so that's just under 4%. So that's not bad for a company that's been around forever. The downside to this is, will it come down further if oil prices come further down, which I don't suspect they will. We are in the driving season, and so I'm still a believer in the red oil smartfolio as well, because of its dividend and its very myopic focus on the oil markets.
Good stuff. I'm going to switch it over to this. So Kelly, why don't you look through the different questions? We got a ton of them, especially at the start. Someone might actually win tonight, not even realize it, because I did not even preface it at the start of this. But we do give away an Amazon gift card every single time on the AI Circle. Your way to win that is actually by basically asking a good question that Kelly picks as our winner tonight. The only qualifications that you have to have, I guess, is you need to be an iFlip user and also using a smartfolio. So most people on here already are, and if you're not, we can happily get you an account all set up. So Kelly, with all that being said, do you have a winner?
I'm going to give it to Jim Tagg.
Perfect.
His NVIDIA questions were generally, they're important questions to ask in these times.
And I'm just going to pick this one, Jim. Jim, you know who you are. We know who you are.
We know who you are.
There was oops, I'm messing up the views here. Sorry about that. There was a handful of questions in there that you asked, so I'm just going to pick the thanks. So Jim, congratulations. I know we briefly chatted yesterday over text, so congratulations on being our winner tonight. So all you need to do is, I guess I should get this back up. All you have to do is just email us at mailbag. Someone on our team will send you over that gift card. And you can maybe get yourself a treat or something like that. So, Kelly, any closing thoughts? Anything you want to depart with?
Yeah, I think the last time, which was 3 weeks ago, we were at a critical junction on the S&P. It was right here. I kind of remembered that we were going to either break one way or the other. Actually, I think it was right in here. Was it? I just kind of remember we did an AI circle and it was pivotal. And I think what ended up happening is I was mentioning it was going to break one way or another. And I think it was right around this date. It did break lower and then moved and made new highs. I suspected it could do either. And by the way, where we are here, I kind of see the same thing. So again, these are pivotal areas in the market, and they have been. We've made some new highs in the indices that involve technology, but the broader market definitely is not as robust as the 7 main stocks that continue, and they have for all year thus far held the entire market higher.
Awesome. And just like we had today, if you didn't get a question asked that you wanted to, feel free to send it on to mailbag. We'd happily cover it next time. And as of now, assuming that nothing changes, our next AI circle will be June 26th at 5:30. And then the one after that is a bit up in the air. I know the holiday, obviously 4th of July is a week or two after that. So be a little bit flexible with us, please. We'll definitely do 2 in July. But the next one for now is June 26th, unless I guess you hear anything different from us. So as always, thank you guys for joining. Kelly, thanks for all your expertise tonight. Thank you everyone for all the good questions. That was a lot of good dialogue tonight, and enjoy the rest of your week.
Thank you, everyone. I think the dialogue was one-sided. I was doing all the dialogue. Thank you, Lee. Thank you, everyone.
See you guys later.